we have manufacturing profit. For manufacturing profit, it's simply talking about a factory that has to produce its goods to be sold in that company. So we have the production department that produce these goods and it's being transferred as purchases. So there's another unit in that company that that sells those products that has been produced. Normally in your trading profit loss account, you purchase goods, then it becomes part of what you make as profit. But in this case, the goods are being produced by the same company, but it's being transferred to the sales department.
Oh, okay. I see.
A business that does not operate a factory, that does not have a manufacturing, a business that does not have a manufacturing company or unit, will not produce its goods. It buys finished goods. So those finished goods bought are called purchases.
Yeah.
But in this case, we have manufacturing profit because this can be recorded when the factory produces a product. The transfer goes to the sales department,
Yeah.
which we now treat it as purchases. So those goods that are being produced, that becomes finished goods, will be transferred to the sales department.
Mm-hmm.
Then the sales department will treat it as purchases.
Okay.
Do you get it? So then there will be a transfer price.
Mm-hmm.
We always have what we call the transfer price. The transfer price, we get it when we calculate the profit markup.
Mm-hmm. Okay.
Do you get it? There's always going to be a transfer price. That means the amount we are putting into the products, the finished goods that is being transferred to the sales department.
Okay.
That's what we call transfer price. So we have activity 5. So the activity 5 said, Emco Metal has calculated that the cost of production for the year ended 31st August 2018 was £160,000. The factory profit is based on a markup of 25%. So we have our cost of production, which is 160. There's nothing you want to do about that. Then we have our factory overhead. So now we go to the markup. They said markup is 25%. So 25% of the formula for markup is selling price minus cost price divided by cost price multiplied by 100.
Okay.
Selling price SP minus CP over CP multiplied by 100. That is markup. Now we have the markup percentage which is 25%. So 25% equals, so let's make the selling price. We need to know the selling price, right? Let's make the selling price to be X. So 25% equals to X minus 160,000 over 160,000. So you cross multiply. 25 divided by 100 is 1 over 4 equals to X minus 160 over 160.
Yeah.
So when you cross multiply, you have 160,000 equals to 4x multiplied by 160 multiplied by 4. So our 4x is 800,000. We need x, which is our selling price. So we divide both sides by 4. So 4x over 4 equals to 800 over 4. 4 has cancelled 4. We have x equals to 200,000. So 200,000 is our profit.
Yeah.
Our transfer price from the factory. But we need, what is the percentage? So now our selling price is 200,000. You less it from your cost of production, which is 40,000.
Yeah.
So 40,000 is what? So the 40,000 here is, we will need to know the percentage of profit.
The transfer.
No, we know the transfer price to be 200,000.
Okay.
The transfer price is 200,000 because it's 800 divided by 4, which is X.
Okay.
We sold for 200,000. That is the point.
Oh.
So the amount we sold is our transfer price.
Okay.
The selling price in the factory is called the transfer price. Do you get it? So, what is the percentage of the factory profit? We have to add it. We know it is 40,000. So how do we get the 40,000? What is the percentage? Not just the 40,000. So to get the percentage, it has to be 40,000 divided by the transfer price multiplied by 100. So 40,000 over 200,000 multiplied by 100 gives us 20%. So 20% is the transfer price.
Transfer price.
Is it clear?
Yeah.
Any question about it? So now we go to unrealized profit resulting from goods manufactured. So here I wrote factory profit. When completing the statement of profit or loss and other comprehensive income, the factory profit included in the closing inventory would have made the value of profit to be overstated. Because it's a manufacturing company, it's a manufacturing unit. So whatever profit we make, that factory profit we wrote, it would have made our profit to be overstated. And remember, in the accounting principle of realization, profit should not be calculated until the goods are being sold. There is there's acceptance of liability from the customer. That is when you calculate the profit.
Yeah.
So this doesn't go in line with the realization concept, which says profit cannot recognize until goods are sold to customers.
Yeah.
But here, the factory has recognized its profit, like the 20%.
Yeah.
Therefore, an account has to be prepared to inform users of how much the factory profit has been included in the finished goods. So we have to understand, we have to let people know, the account users, maybe the investors, the accountants, the managers, that whatever amounts or whatever the value of the finished goods are, the factory profit has been included.
Okay.
So in the cost of preparing the statement of profit or loss and other comprehensive income, this amount has to be included in the profit for the year. So it should be added after calculating the gross profit and deduction of expenses. So it means our factory profit should be calculated after getting our gross profit. So you add it to the gross profit.
Okay.
Then you less it from expenditure.
Okay.
Our closing inventory. For closing inventory, the closing inventory is overvalued as factory profit has been added to it. Therefore, the unrealized profit must be removed from the statement of profit or loss. Our closing inventory of raw materials.
Yeah.
You have overvalued it because you have added factory profits to it. So that means you have to take it away in your statement of profit or loss account. Is it clear? So therefore, it is an unrealized profit. It's a profit that we have not gotten, but the factory assumed that it has made the profit. That's why I call it unrealized profit. An unrealized profit is markup divided by 100 plus markup multiplied by the value of closing inventory. We talked about that already. So that takes us to the effect of profit. Effect of factory profit on statement of profit or loss and other comprehensive income. A decrease in provision for unrealized profit will increase the total amount of profit earned, therefore it should be added to profit. So what they're saying is this: if your unrealized profit is a provision, like we're talking about the factory profit. If the factory profit reduces, it increases your profit. So it means if our unrealized profit decreases, it simply means that we don't have unrealized profit, rather we have profit. So if unrealized profit increases, it means our profit will reduce. Get the point here? Provision for unrealized profit. If it reduces, it means we no longer have unrealized profit.
Yeah.
So whatever profit we have
have
is our profit, then it's increasing. Put in mind, unrealized profit increasing, profit will reduce. If unrealized profit is reducing, profit will increase.
Okay, it's the opposite.
Yes. Is it clear?
Yes, so it's key. Yeah.
We go to activity 10.
10. 6.
No, we didn't do 6.
There's no 10.
Yeah. Activity 6, sorry. I keep saying activity. I don't know why I wrote activity 10. It's activity 6. So they said, Samuel owns a manufacturing business that makes leather goods such as gloves and wallets. Finished inventory is transferred from the manufacturing account to the statement of profit or loss and other comprehensive income at the production cost plus 50%. So the following information for inventory is available. Raw materials, the closing opening inventory of raw material and the closing, we have it. We have the work in progress and the closing work in progress. We have the finished goods and we have the opening finished goods and the closing finished goods. But here, we need to calculate the amount of unrealized profit to be charged to the statement of profit or loss and other comprehensive income. So we have our finished goods, our opening finished goods for 50,400. 50% of it, that's 16,800.
Yes.
Then our work in progress, our closing finished goods, 74,400 or 50% again, or 50 over 150, which is because it's added, 50% is added to it. 50% is added, so it's 50 over 150.
Yes.
Instead of 50 over 100, it becomes 50 over 150, because 50 is added. Do you get the point I'm making here? So our cost is now 50 over 150, that gives us 24,800.
Okay.
So 24,800 minus 16,800 gives us our expenses, which is unrealized. So that's 8,000. So it will be 8,000 we consider as expenses, and will be taken away from our profit of manufacturing account. Is it clear? But that ends it. Okay. Evaluation of what?
Prepare an extract stating the financial position compared to August.
Yeah, the 8,000 goes there. What else do you want us to do?
Thank you so much, Mr. You're so smart, teacher. Thank you.
That ends manufacturing account.